Yinz Know, you can actually give more than $19,000 to a person and not pay taxes on it. This is one of the most misunderstood provisions of the tax code that I really see from clients. I also see from other financial planners. So here's the scenario. I have a couple sit down and they've grown their assets and they've already given some money to their church and their charity and they want to be generous to their children. Or maybe it's a friend they want to help out. And they want to give their child, say, $25,000. And they're like, Greg, I read online, I put in ChatGPT or whatever they did, and I can only give $19,000. I want to know how to give more. Or maybe they're a married couple and they say, Greg, you know what? I want to give $38,000. See, what they do is they take this $19,000, they realize, well, I could give and my spouse could give. And so if it's our son and my wife and I want to give to our son, well, guess what? That's $38,000 we can give. Then I'll start getting really creative. Like, but I also want to give to his wife. Okay, so that's $38,000 for her, $38,000 for him. Hey, I want to give my grandchildren, right? So you get $38,000, you get $38,000. We're like Oprah. Everyone wins. But I ask them, do you want to give more? Yeah, I want to give more. But I can't. Why not? Well, it says on ChatGPT, it says online, I can only give $19,000. See, what people don't realize, that's an exemption amount. It's an exemption towards your annual lifetime gift, which is based upon the estate tax. So with the new big, beautiful bill that passed, the federal estate tax is now $13.99 million exemption per person at $27.98 because we have portability. You don't have to create an AB trust anymore. You just get that $27.98 if you're married, portability. So most people I work with don't have $13.99 million per individual or $27.98. I work with Yinzers. I do generational planning for Yinz. And most of my clients, that they start to get to there, you know what they do? They gift it to their church and they gift it to charities. Because they say, God has provided me so much provision, I want to be generous with it. So I don't work with these type of people. Maybe you do. That's great. Maybe you are one of those people. God bless you for getting those blessings. But the average person, this federal estate tax, now that's made permanent with the big beautiful bill, is something that shouldn't be part of their brain. Right? Maybe they hit the Powerball, we got to worry about it, and I'll refer them out to some other financial planner. So what this is, this says if you die and your estate's bigger than $14 million, right, I'm rounding up there, that you have to pay federal estate tax. Oh, people say, well, that's great, we could gift it away, so that's what the gift tax is. The gift tax is, well, you can't just give it away because if you were going to die, we're going to charge you, so we're going to charge it to you while you're living. So, you know, here's an example. Somebody's got $20 million, and they gift away $20 million, right? They go down to zero, so they have to pay the federal estate tax. Well, hold up there, you have to pay $6 million, right? That's 20 minus the 14, I'm rounding up, it'd be actually a little higher than that. So that's how gift tax works. But there's an exclusion amount. And what that exclusion says is you can gift that amount and it doesn't impact this number. It also means you don't have to file a gift tax return. And so this is where people get a little bit messed up on this. So the first thing is, Greg, if I only have $5 million, right, I'm married, so we're going to 27.98 to this effect, why should I take advantage of the exclusion? Well, it's simple, because laws change, right? When I started this profession, it was $600,000. Now it's 27.98. That's a little bit higher than inflation, right? Or should be 13.99, a little bit higher than inflation. So let's talk about what you can gift and how you can gift, and let me just break this down and give you an example. So here's a common scenario. So let's just, for this one, let's just use a single person. Let's not use married individuals for this because it's just easier math, and let's just do one scenario. So I have a widow. She's done very well for herself, and she says, Greg, I want to do the giving while I'm living. I don't want my children to inherit money. I want them to have the money right now. I want them to take the grandchildren to Disney World, and I want to give, and I have one son, right, and one grandchild. I'm single, and I want to gift them $30,000. And I want to do that at Christmas time, right? Because I just want to just celebrate the Lord and Savior this way. I want to give them $30,000. I want to celebrate it. That's great. This is common, by the way. And we say, all right, we take that $30,000 and you're giving us to your son. So that's $19,000. So we subtract out that $19,000. So what does that leave us with? In this case, it leaves us with $11,000. Now, you could say that you gave part of this to your son and part of it to your, in this case, you have one grandchild, and we can make that amount larger. You better gift that as two separate checks. Let's keep it simple. Say she just gave it to the child, the son. So what do we do with this $11,000? If this was in 2025, she'd have to file a 2025 gift tax return. And all that gift tax return would say she gave $11,000. She does not owe a gift tax on it. She only owes a gift tax if that entire amount excludes what the annual lifetime is at that point in time. So now that goes in the $11,000 column. Next year she does the same thing. Let's say this is not adjusted for inflation, which it will be in the current legislation. That's another $11,000. So now her lifetime is up to $22,000. Now, God forbid something happens to her, and now we take our 13.99, and it gets adjusted for inflation, by the way, in a new tax bill. But let's just say for this sake and purpose, it's 13.99 million. We're rounding up here, and we take the 22,000, we subtract this, and the amount is less than zero, so she owes no federal estate tax. The cumulative each year was not above the gift tax. So really, for most clients, you do not have to worry about this. Give freely, give generously to those you want. The most important thing should not be the tax considerations. It should be, how does your financial plan survive this? I mean, one of the things I always like to say when you're on a plane, they tell you to put the oxygen mask on first. I like to tell my clients, worry about yourself first and your children second, right? I also say you should worry about charities first before your children. That's just me personally. We want to give generously and live generous lives. You have a lot of room and freedom to give. This came up with 2 different clients today, which is why I'm recording this video, because I feel like a lot of you didn't know this. If you'd like to talk more about what you can give to your children, you want to talk more what you want to give to your charity or your church or anything else, we would love to talk to you how you can make giving and living generously part of your financial plan. Reach out to us today.